Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 13th of June. I'm Daniel Lam, your host for the podcast. Yesterday, we spoke about how U.S. equities have been enjoying a period of low volatility and the fund inflows associated with such. Today, we would like to look at the U.S. in perspective vis-a-vis China, the two being the largest economies in the world. Arguably, the divergence in the labor market is the key factor explaining the growing gap between U.S. and China economic sentiment. While the U.S. unemployment rate recently rose to 3.7% from 3.4%, the labor market still looks very solid, even after more than 500 bips of FOMC rate hikes. Now, China's headline urban unemployment rate is also at a healthy 5.2%. However, the youth unemployment rate is close to 20%. That's for those aged 16 to 24. Thus, there could be a structural risk on the China economy, i.e., if China's youth unemployment rate stays high, it may keep a generation of workers underemployed, hurting the spending levels and eventually the growth potential of the Chinese economy. But is this concern overdone? Well, let's take an example from the recent softness in commodity prices. These have been associated with China's macro weakness. But if you look at China's commodity import data in volume terms, you see that demand has actually been picking up for copper, crude oil, and soybeans. So this also suggests that concerns about China's record trade surplus and poor import performance may be exacerbated by a terms of trade shock. So take out the price effect, and China's demand does not look quite so poor. Moreover, this recovery in China is spearheaded by service and the consumer, and this may channel the spending to smaller items such as leisure. Very different from the past recoveries, which focus upon large items like real estate and investment activities. So the relative performance in equities suggests that investors believe the US can withstand FOMC tightening and the credit contraction, while China's economy is failing to reignite after coming out from the lockdown. This may be prone to potential reversal. We've been pointing out that US equities is currently the investors' quote-unquote comfort zone. But there are emerging catalysts that may trigger the return to Chinese equities. For example, the upcoming visit from Blinken may lead to a potential thaw of relations between the US and China, which may help narrow the quote-unquote China discount in the near term. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.